CRT time algorithm. The times 1, 5, and 9 a.m. are important for market activity as they influence price movements and help set patterns. Algorithms use these key moments to track market trends and adjust prices more effectively, ensuring they stay in sync with market changes. By analyzing the chart and repeating the algorithm within this time range, a trading strategy can be developed using candle range theory. The CRT model is a three-candle pattern used in trading. The first candle establishes a price range. The second candle creates a false breakout by wicking beyond this range, triggering stop losses and attracting traders. The third candle confirms the move by breaking out of the range in the opposite direction. Given the market's significance and activity between 1 and 9 a.m., the formation of the CRT pattern is consistently possible. As we mentioned, the CRT model is a three-candle pattern, and the time frame between 1 and 9 a.m. can be divided into three 4-hour candles. The 1 a.m. candle forms the range, the 5 a.m. candle manipulates this range, and the 9 a.m. candle breaks the range to determine the market's direction. By reviewing the chart on the 4-hour time frame, we can see that this pattern has repeated between 1 and 9 a.m. During this interval, the market has moved in one of two ways. Either a turtle soup pattern has formed, or the price has broken through either the high or the low. This is also clearly visible on the chart. Between 1 and 9 a.m., the market either forms a CRT pattern due to a turtle soup setup on the second candle or breaks through the range candle without any manipulation. Even though a CRT pattern has formed, it is not suitable to enter a trade due to the lack of confirmation on the 4-hour time frame. Therefore, we will use the 5-minute time frame free. Additionally, we will apply the AMD and turtle soup methods to identify the optimal entry area. In trading, the term AMD or power of 3 focuses on 3 phases of market behavior: accumulation, manipulation, and distribution. The accumulation phase occurs when the market is range-bound, typically with low volatility and minimal price movement. It is a period when institutional traders begin accumulating positions in anticipation of a significant move. During this phase, traders may notice small candlesticks and low volume, which indicate that no major market move has yet started. Following accumulation, the market may create false breakouts, where the price moves sharply outside the established range to trap retail traders. This phase involves triggering stop-loss orders, commonly known as stop hunting. The goal here for smart money is to create liquidity by deceiving traders into entering premature trades before reversing the price back to its intended direction. After the manipulation phase, the market moves decisively in the intended direction. This phase shows increased momentum with larger candlesticks and higher trading volume. It is during the distribution phase that smart money capitalizes on their earlier positions by driving the price in the expected direction and profiting from the market's movement. By analyzing the chart, we observe that the 3 stages of accumulation, manipulation, and distribution repeat in a continuous cycle. The most critical stage is manipulation, as it often leads to the formation of a turtle soup pattern. A turtle soup pattern occurs when the price breaks through a prior high or low, leading many traders to expect the price to continue in that direction. This breakout typically happens with a large candle or wick. However, instead of following through, the breakout fails, and the price reverses, catching those who traded the breakout off guard. We will analyze 3 consecutive time intervals from 1 to 9 a.m. to understand how to enter a trade and avoid potential mistakes. When analyzing the 5-minute time frame, we observe that the market initially forms equal highs and lows. Then, by breaking these highs and lows, it triggers a liquidity sweep. After this, the main market move begins, indicating that the 3 main phases, accumulation, manipulation, and distribution, have fully developed. Additionally, on the 4-hour time frame, the 1 a.m. candle marks the accumulation phase, the 5 a.m. candle marks the manipulation phase, and the 9 a.m. candle marks the distribution phase. To enter the trade after identifying the range formed by the 1 a.m. candle, a turtle soup pattern should form on the 5 a.m. candle. In this setup, the price should break through the range zone and then reverse, creating a market structure shift. After forming a turtle soup pattern in the 5 a.m. candle closes, we consider the 9 a.m. to 10:30 a.m. time window for trading. We take the order block or fair value gap that causes a market structure shift as the entry area, set the stop loss slightly above the order block, and use the previous support or resistance level as the take-profit target. Please remember that the entry time for the trade should be between 9 a.m. and 10:30 a.m. This means the 5 a.m. candle should be formed and closed to ensure confirmation from the turtle soup and the market structure shift. Let's pay close attention to the 5-minute time frame of this chart. The market has once again formed a turtle soup, followed by a market structure shift. However, why is this pattern not suitable for entering a trade? In the previous point, we emphasized that the appropriate time for turtle soup and market structure shifts is between 5 a.m. and 9 a.m., meaning the 5 a.m. candle should form and close within that 4-hour time frame. In this chart, the turtle soup occurred at 10 a.m. Therefore, even if the price returns to the order block or fair value gap, there is no reason to enter a trade. In this strategy, we use the 3-candle CRT pattern for trading. Finally, we will review the step-by-step process of entering a trade on this chart. In the 1 a.m. candle, the market began to form equal highs and lows. Then, in the 5 a.m. candle, the market broke the established range but quickly turned bearish again, re-entering the range area. The main reason why the 5 a.m. candle needs to form and close before entering a trade is quite clear. If you consider this a turtle soup and a market structure shift, and select the area of the order block for your entry, your trade could fail due to a subsequent price retracement. If we postpone our trade timing to after 9 a.m., the turtle soup and market structure shift will be clearly visible. Therefore, we consider the fair value gap or the order block that caused this market movement as an entry zone. So, do not rush into a trade. Instead, wait for the entry confirmations to form. And the last point is to set your trading time zone to UTC for New York. I hope this video has been helpful for you. Please don't forget to like and subscribe.